In my last post about 4 weeks ago, I value Tesla. And as always, whenever I value Tesla, I get a lot of feedback. Some of it disagreeing with me on the value being too low, and some of it disagreeing with me about the value too high. So to remind you, the value that I got for Tesla in my base case was about $186. A few of you decided that I was being far too pessimistic about the future for Tesla and that I should be using much higher growth rates. Far more, though, took me to task for being far too optimistic in my valuation. I have no desire to relitigate the valuation of Tesla because valuation is about differences. So if your value for Tesla is different from mine, I think that's healthy. That's why we have buyers and sellers. I do want to talk about one aspect of the criticism that I think needs to be re-examined, which is share count. Some of you, in fact many of you, took issue with the way I dealt with expected future dilution that I see coming for Tesla. In fact, I was pretty open about the fact that Tesla will have to issue new shares in the future if it wants to grow to become the company that it plans to be. And many of you wondered why I was not adjusting the share count for this expected future share issue. I thought a post about share count has been long overdue because this is a part of discounted cash flow valuation that I think we take for granted, but we cannot do so anymore. Let me take you back 30 years. When I wrote my first valuation book, I did not deal with share count very much. In fact, here's the way I dealt with share count. I valued the equity in a company and I divided by the number of shares outstanding to come up with the value per share. That was it. And in the old days, that's all you needed to do, divide the value of equity by the share count. In the last 3 decades, there have been 3 developments that have made this process much more difficult for people who are valuing companies. The first is that more and more publicly traded companies are coming to the market where they're still young companies that still need to access markets, that are losing money and need lots of money to reinvest in order to grow. What does this mean? It basically means that when you do a discounted cash flow valuation of these companies, your expected cash flows for the foreseeable future are going to be negative. You're saying, so what? In a discounted cash flow valuation, when you have negative cash flows, you're predicting that a company will have to raise capital to keep going through those years. And if it's a young money-losing company, that capital will probably take the form of new equity, which also means that there'll be future share issuances, which of course opens the door to dilution. So that's the first thing, is there are shares outstanding today, but those shares outstanding will be expected to grow over time as you issue more shares to cover those future negative cash flows. First problem. The second is, increasingly in the last 3 decades, companies have moved towards giving employees stock-based compensation. Of course, this has always been around, but before the 1980s, it was designed to keep incentives aligned. In other words, to make managers think like owners. In the last 3 decades, a big chunk of stock-based compensation is coming from companies because they cannot afford to pay cash to keep their employees online. So they pay them with stock or with options. That in turn also creates a dilution issue. And in the case of options, it's particularly tricky because those options could become shares if the share price goes up above the strike price, or it would expire worthless if the share price stays down. So they're potential shares but might never show up. And there's a third issue that I think that we increasingly face that we did not have to deal with. In the 1980s, the typical US company had only one class of shares. Every share had the same amount of voting rights and the same claim on cash flows and dividends as every other share. So you could just divide by the number of shares outstanding. That was because the New York Stock Exchange required companies that listed on it to have only one class of shares. The NASDAQ in the 1990s changed that equation. In the 1990s, you saw a lot of young companies get listed on the NASDAQ, and they were okay staying on the NASDAQ, and the NASDAQ did not require that all shares have the same voting rights. Google, in fact, was a company that completely opened the door to this process by issuing shares with different voting rights and then becoming incredibly successful as a company. That provided a roadmap for almost every social media company that went public to have 2 classes of shares. Why does that matter? If you're voting and non-voting shares in a company, there are actually different claims on equity, and you could argue that the voting shares should trade at a higher price than the non-voting shares, and that therefore you cannot just divide the value of equity by the total number of shares outstanding. So those 3 issues: potential future dilution to cover negative cash flows, stock-based compensation, and the fact that if shares with different voting rights are making our lives more difficult. And what I'd like to talk about is how best to deal with all three. Let's start with expected dilution. It's not as if companies before the 1980s never had negative cash flows. There were no young companies, but before the 1980s, those companies stayed private. Venture capitalists priced these companies. And I've argued before, venture capitalists don't value companies, but they did not come into the public marketplace. That, of course, changed in the 1990s with the dot-com boom, when a number of companies were young companies. Young in what sense? They were still losing money, their business models were still in formation, they still needed to access capital markets, decided to go public. And even though the dot-com boom is now a distant memory, there are other companies in other markets, in other sectors that have chosen to adopt the same route. And there are far more young companies out there now in the public marketplace than there ever used to be. What does this mean? If you're an analyst stuck in the old ways, you refuse to value young companies that have negative cash flows, you're cutting out entire segments of the market from your perusal. So we have to figure out good ways of bringing in expected dilution into our discounted cash flow valuation. Because here are the consequences when you have expected negative cash flows. And those negative cash flows are coming from two factors. One is that many of these young companies are still money-losing companies. And the other is they need to reinvest huge amounts to keep growing. So you bring those two things together. You're losing money, you have to reinvest. You're going to have negative cash flows. Those negative cash flows have to be covered with new capital raises. And as I said, that capital has to come either from equity and debt. Given that these are money-losing companies, it's very unlikely that they can borrow enough money to cover the capital, that the bulk of this capital will have to come from equity, which in turn will create new shares. So let's start off by stating the obvious. When you have expected negative future cash flows, you're going to get dilution, and that dilution is going to reduce your ownership stake in the firm. The question is how best to deal with it. Let's start with the right way to do this. And in a discounted cash flow valuation, here is the reality that should make you very happy. You don't have to do a thing. Your discounted cash flow value per share already reflects dilution. You think, how can it be? Well, remember those negative expected cash flows in years 1, 2, 3, 4, as far as the eye could see? When I take the present value of those negative cash flows, I'm lowering the value of the operating assets today. I'm in effect reducing the value for expected future dilution. And because I've already done that, I can just divide by the actual number of shares outstanding. You're saying that's too good to be true. That can't happen. Let me use Tesla to illustrate this process. In my valuation of Tesla, my expected cash flows are negative for the next 8 years. That is in my optimistic view of the company, because to grow as much as I want them to grow, they have to reinvest huge amounts of money. They have negative cash flows. If you look at the value that I get for Tesla's operating assets, including those negative cash flows, the value that I get is $41.33 billion, and netting out debt and adding back cash, a value of equity I get is about $32.1 billion, which translates into a value per share of about $189. That was my original valuation. Just to show you that the dilution is embedded in there, think about what the present value would have been if I did not have those first 8 years of negative cash flows. It would have been almost $16.2 billion higher, $57.5 billion. You net out the debt from that, the value of equity I'd have got would have been $284, not $189. In effect, I am applying a 33.4% discount to my value because I have negative cash flows. That is the dilution discount. Implicitly, though, I'm making an assumption here. I'm assuming that when those free cash flows will get covered with new share issuances, those new shares will be issued at my estimated intrinsic value, which is $189, growing at my expected price appreciation over the next 8 years. That is an assumption. It's the assumption that's consistent with my intrinsic value view of the world, and you can argue maybe it's unrealistic. There is a second way in which you can bring in expected dilution, and here's what you would need to do. You would need to make an assumption about the price at which you can issue shares in the future. This creates a circularity because you're trying to value the company today, and to value the company today, you got to estimate the price in the future. But let's say you're willing to do it. For instance, let's assume that you think the price at which Tesla can issue shares is $200 per share, and that you expect 88.06%. The reason it's so specific is that's the debt ratio I use for my cost of capital. 88.06% of my capital will come from equity, and that the price will appreciate by about 9% a year. So the expected price next year will be 218, growing at 9% the year after, and so on and so forth. I take my expected free cash flows every year for the next 8 years, which is what I'm going to be covering with my new stock issuances, and divide by my expected price. I get the number of shares I will have to issue, and with my estimated price, I will need to issue 69.35 million shares over the next 8 years to cover my negative cash flows. What am I going to do with that? I'm going to add that on to my existing share count, the current share count, to come up with a total number of shares of 239.11 million. I'm going to divide the value, but the value that I'm going to divide will replace my negative cash flows with 0. Why? Because if I'm going to increase my share count to reflect the shares I'm going to be issuing, I cannot also count the negative cash flows as part of my value. The value that I get without the negative cash flows is 57.5 billion. You subtract out the net debt, you come up with the value of equity, you divide by the total number of shares. So dividing the value of just the positive cash flows by the augmented share count gives me a value of about $202 per share. Now I might be a little puzzled as to why the value is higher than the value we got with the cash flow approach, but the reason is simple. I've assumed that Tesla can issue shares at above the intrinsic value, and to the extent that you can, it increases the value per share today because you're in effect taking advantage of overpricing. So here are your two choices. You can do a traditional discounted cash flow valuation and let the negative cash flows take care of the dilution, just divide by the actual share count today, or you can ignore the negative cash flows and adjust the share count for expected shares issued in the future, though you have to make an estimate of what that price will be. But you cannot do both, because if you do both, you'll be double counting. You'll be punishing the company twice, once in the negative cash flows and once in the share count for the same issue, which is dilution. Let's move on to share-based compensation. Share-based compensation has been with us forever, as long as companies have been around, as long as businesses have been around. That said, it took off in the 1990s for two reasons. One was an attempt by Congress to put a cap on management compensation, but they left a loophole where options were not counted as part of management compensation. Not surprisingly, companies took advantage of that by issuing a lot of options. The second was a lot of young companies came into the public markets in the 1990s. These companies were value rich, they had high market capitalization, but cash poor. To attract employees, they had to pay with equity. They used options primarily, and some of them used restricted stock. Along the way, they were aided and abetted by accountants who told them that if they issued options that were at the money, they were giving nothing away. In other words, they had to show no expense. So it allowed companies to give big compensation packages without showing it as an expense. The consequence was simple. The first was, when you valued a company and you came up with the value of equity, you could not just divide by the number of shares outstanding because you had a drag on that value from options that had been issued and were still outstanding. That was another claim on the equity. The second was, to the extent that these companies were expected to continue doing what they were doing, issuing more options and more restricted shares, that's going to be an additional drag on your value because your future earnings, your future cash flows are going to be reduced by that expected dilution. Here's the best way to deal with this. For past options and past restricted stock, let's take the easy part first. If you've made restricted stock issues in the past, just count them as number of shares outstanding. I know they're not quite shares because there are restrictions on trading, they might not be vested, but take the easy way out, just count them as part of the shares outstanding. Options are a different game. They're not quite shares outstanding because potentially while they could be shares, it depends on what the share price does. Use an option pricing model to value those options as options, reduce the value of equity by that option value. You've taken care of the options. Because you've taken care of the options, you can just divide by the actual shares outstanding, not have to worry about dilution in the future. That's already captured by the option value. Future option grants and restricted stock grants are expenses. Reduce your future income and cash flows for those grants. It'll reduce your value for the operating assets. That's in fact fair. It's not double counting because you're taking care of a different problem, expected future issuances. So past option grants and restricted stock take out of the value of equity. Past option grants take out of the value of equity. Count restricted stocks in the past as part of shares outstanding. Future grants reduce your future cash flows and your value. You've taken care of it the right way. To show you how this would play out with Tesla, let me first note the magnitude of stock-based compensation at the company using the 2018 first quarter numbers to illustrate. In the first quarter of 2018, stock-based compensation at Tesla showed up in cost of goods sold, R&D, and SG&A and amounted to almost 4.16% of revenues. And it's been doing it over its entire lifetime. And the way this shows up, at the end of 2017, Tesla had 10.88 million options outstanding with an average exercise price of $105.56 and a weighted maturity of 5.3 years. They also had 4.69 million restricted stock. Let me deal with that in my discounted cash flow valuation. I took the value of equity that I got using the cash flows, and I included the negative cash flows. I'm using the cash flow approach for dealing with dilution. But from that 32.1 billion, I subtracted out the value of 2.9 billion in options. Where does that value come from? I took the 10.88 million options and I valued them as options using the exercise price of $105.56 and the weighted maturity of 5.3 years. I've taken care of the options. I counted the restricted shares as part of the shares outstanding of 169.76. I've taken care of the backlog of past option grants and past restricted stock issues. You're saying, what about the expected future option grants and stock issues? Accounting has caught up with the times. Today's accounting, both IFRS and GAAP, you're required to show your stock-based compensation as an expense. So Tesla's current operating losses already reflect the expensing of options, and to the extent that I'm building off those losses and projecting a margin that incorporates their compensation expense, I've taken care of expected future option grants and restricted stock issues, at least indirectly through my expected future margins. I've taken care of my stock-based compensation. There is an alternative approach which you can use, which I'm going to call a sloppy alternative, and it's called the Treasury stock approach, and it is specifically aimed at options outstanding. Here's what analysts do. They take the exercise proceeds you will get if the options get exercised today and add it onto the value of equity. So they act like the options get exercised right away, and they divide by the total share count that will be around if the options get exercised. In effect, you're valuing the options at exercise value. You're ignoring the time premium of the options. And because you do that, you're going to overvalue companies, as I have with Tesla. Applying this approach, the value that I get for Tesla of $184 is much higher than the value that I got when I did it right by valuing the options as options. So my suggestion is don't go down this route. And even if you have a problem with option pricing models, remember the worst option pricing model out there will still do a better job than one that assigns a value of exercise value to every option. Finally, there are two practices related to stock-based compensation that are abysmal that I think we need to stop. The first is adjusting the number of shares for expected dilution. So basically, you count the 10.88 million options as if there were shares outstanding. You do no other adjustments. And in fact, you act like these options get exercised and no proceeds come into the firm. It's even worse than the Treasury stock approach. The value that you get is about $178 per share. The other practice that I find troubling is the practice of adding stock-based compensation back to the income on the basis that they're not cash expenses. This is silly. These expenses are in-kind expenses. You're giving away a share of ownership in the company. They should be treated like regular expenses. So I would leave the stock-based compensation as part of expenses and not add them back. So bottom line on stock-based compensation, to do it right, you have to value the options that are already outstanding there as options. You've got to count the restricted stock as part of your shares outstanding. And you've got to count in the fact that the company is not quite done as expected margins in the future. Finally, let's talk about shares with different voting rights. If you think about it, founders and families, when they take their companies public, often want to have their cake and eat it too. They want to get access to external capital, but still run the companies as if they were their own. And if you have shares with voting rights and different voting rights, founders and families are able to have their cake and eat it too. By holding the shares with the voting rights in their hands and issuing shares with low or no voting rights, they're able to keep control of the company while getting access to capital. But there is a cost to doing this. And in fact, there are two consequences. The first is when you have shares with different voting rights, change at a company becomes much more difficult. Good change, bad change, all kinds of change. So if a company is suboptimally run, if it has voting and non-voting rights, changing management becomes much more difficult at the company. The second is when you have two classes of shares, they're not quite equal. So you can't just divide your value of equity by the total number of shares outstanding, because voting shares and non-voting shares are different claims on equity. So here's the right thing to do. When you do your valuation, if you're voting and non-voting shares, you've got to incorporate the fact that change is difficult into your valuation. What am I talking about? Let's take a simple example. Let's assume you have a company with no debt, but it can really have a 20% debt ratio. So when you do a traditional valuation, often you will change your debt ratio towards the optimal, assuming that over time, companies will do the right thing. But if you have companies with voting and non-voting shares, if managers don't like to borrow money, the founder family, they will never borrow money. So when you value a company with voting and non-voting shares, don't put in changes. Even if a company is badly run, it might continue to be badly run. That's going to lower your value for the company. And once you've got the value of equity, you have to allocate that value between voting and non-voting shares, and that requires you to make an estimate of how much the premium will be for voting versus non-voting shares. Two ways you can estimate that premium. One is by looking at studies of voting and non-voting shares, and at least based on US and European companies, the premium is between 5 and 10%. The other is an intrinsic valuation approach. It's a little too messy to describe here, but basically what you do is you value control in the firm and you give it to the voting shares. So the more badly run a company is, the greater the premium there will be to voting shares versus non-voting shares. And here's what you will do with the premium. Let me use a simple example. Let's assume you have a value for a firm of $210 million. Let's assume that it has two classes of shares, 50 million voting shares and 50 million non-voting shares. Let's assume the voting shares have a 10% premium over the non-voting shares. To estimate a value per non-voting shares, here's what I'm going to do. I'm going to divide the 210 million, not by the 100 million shares outstanding, but by 110 million. Why 110 million? Because I'm going to take the voting shares and I'm going to scale them up for the premium. That effectively gives me a value per non-voting share of $2 per share. The voting shares then will trade at a 10% premium, which is $2.20 per share. That's a typo right there. But if you add up the two numbers, you get 210 million. Effectively, you've built in the premium. So here's the bottom line. I know a lot of you don't do discounted cash flow valuation, might not even believe in it. You do pricing, use price earnings ratios, EV to EBITDA multiples. Nothing wrong with that. But remember, everything we've talked about in this session applies to you as well. And here are some suggestions I would have, even if you're just doing pricing. First, when you compute multiples, stay with aggregate numbers. Let me give you an example. The way we usually compute price earnings ratios, we divide price per share by earnings per share. Given the messiness in per share values, I would suggest computing the price earnings ratio by taking the total market capitalization of the company and dividing by net income. Fewer chances of making bad mistakes. Second, when stock-based compensation is rampant in a sector and varies widely across companies, you have to control for differences in how much stock-based compensation there is in a company and how it's granted. There's a big difference in how pricing is affected, or multiples are affected by whether you grant restricted stocks or options. So you got to factor that in and control for those differences. Third, don't add back stock-based compensation on that ill-thought through logic that it's not a cash expense. Earnings are earnings, just stay with those earnings. Don't add back stock-based compensation. And finally, with young companies, often you will see analysts use forward multiples, take an expected EBITDA, an expected revenue, and expected earnings in a future year and apply a multiple to it. Nothing wrong with that, but remember, if you have large negative cash flows and your company will have to issue new shares, your claim on that future value will be much smaller than your claim today. You got to adjust for dilution when you use forward multiples. So everything we talked about in the context of discounted cash flow valuation applies to you as well, even though you're doing pricing. So I hope I've dealt with some of the confusions relating to share count in this session, but I would suggest in your next valuation you pay a lot more attention to those number of shares outstanding. Thank you very much for listening.